Hi, this is John Coumarianos, analyst at Real Investment Advice and Clarity Financial. A famous academic study in 1992 showed that value stocks, those with low price to book ratios, outperformed other stocks over long periods of time. However, over the last 10 years, that has not been the case, prompting some analysts to say that value might be due for a rebound. Let's look at the numbers. You can see the Russell 1000 Growth Index has outperformed the Russell 1000 Value Index by almost 4 percentage points, almost 11% annualized return to around a 7% annualized return for the last decade. So is value due for a rebound? It may well be, and here are some fund options available to you if you want to bet on value coming back. The first fund we're going to talk about is the iShares Russell 1000 Value ETF. If you're banking on value making a rebound, this would be the simplest, easiest choice for you as a fund, as a stock fund. Second choice is an equal weighted index fund. This fund will take the 500 biggest stocks, and instead of ranking them the way the market ranks them, it'll rank them equally, so about 0.2% in each stock. Your next choice is the PowerShares FTSE RAFI US 1000 Fundamental ETF. This one ranks stocks on 4 fundamental metrics: sales, cash flow, book value, and dividends. And it may be a smarter way to rank stocks than by the market capitalization, by how much the market loves them. The choice after that, the PIMCO RAE Fundamental Index, same type of fund. It takes the same index, but it gets exposure to that index through a derivative that's collateralized by a bond portfolio. And there's a little bit of trading in that mutual fund, so it's probably better owned in a tax-advantaged account. Next choice is the iShares Edge MSCI USA Value Factor ETF. This fund is unique in that it takes the sector exposure of a parent index called the MSCI USA Stock Index, and it invests in the cheapest stocks in that index by sector. So it keeps the sector weightings. And that's important because if technology stocks, for example, are very expensive, they're going to occupy a large place in the index. This fund won't mitigate that. It'll keep the big sector exposure that technology has, but it will choose the cheapest stocks in that sector and in every other sector. The final choice is maybe the most unique fund in this lineup, the Double Line Shiller Enhanced Cape Fund. This fund invests in 4 of the 5 cheapest sectors based on the cyclically adjusted PE, or Shiller PE metric. So it's also sector specific. It judges the market by sectors, and it chooses 4 of the 5 cheapest ones. It chooses the 5 cheapest, and it throws out the one with the worst one-year price momentum. So it has what we could call a momentum filter. This fund, interestingly, many people think technology is very expensive right now, but this fund actually has the four sectors it has exposure to are technology, healthcare, consumer discretionary, and consumer staples. A way for investors to get exposure to U.S. stocks now might be to split their allocation to the Double Line Fund, since that has technology exposure, because the metric it's using is saying technology is not expensive, growth stocks are not expensive relative to their histories. And the other value funds at the top of the list, because they're value funds, they will tend to not have as much exposure to technology. They will tend to have exposure to energy, utilities, industrials and materials, and financials. So splitting your assets between the Double Line Shiller Fund will get you some growth stocks, and one of the other funds will get you some traditional value stocks. Thanks for watching. This is John Coumarianos, analyst for Real Investment Advice and Clarity Financial.